Hey, buddy, Boris Susswick. Welcome to our weekly edition of Where Are the Trades for February 2nd through the 6th, 2015 edition. Interesting week. Continue to have lots of volatility in the crosses and the majors. But if we start with the euro, we see finally a little bit of semblance of stabilization, at least on a technical basis. Still, though, and I think this is kind of very interesting, we're coming into a week where we have two primary trends that could resolve this either one way or the other. The big trend on the US dollar side is, of course, the non-farm payrolls. That's going to be a big event at the end of the week. If those print very strong, that's going to give the market a lot more confidence. The Fed is going to begin hiking rates by mid-June. On the other hand, if the numbers out of the NFPs are sort of the same warmed over data that we've seen for the last couple of months, that is just 200,000, no wage growth, relatively tepid growth, the potential for euro to make fresh lows becomes more and more remote. We've made these spike lows at 111. On the other hand, there is one other factor that could test us to the downside, which is the developing story with Greece, where Greece is now clearly not willing to negotiate under the terms that the Europeans wanted to. And there is a potential here for a spin-off of Greece. And it's a big unknown, not in the sense because of Greece being a big factor of the Eurozone. It's only 2% of the GDP. But what are the potential ancillary possibilities of what happens if Greece essentially does abrogate its contracts, doesn't pay its debts? Does it get pushed out of the Eurozone? What happens to various obligations within the Eurozone system? How can the ECB be a backstop? All of this creates sort of uncertainty and I think a serious amount of risk here, and I kind of want to show you something. So this is Euro Swiss, and you see Euro Swiss in many ways I think is a reflection of whether this is a gauge of serious risk or not. For the last 4 or 5 days, we've seen a big rally in Euro Swiss as the market kind of relaxed about the idea of any negative fallouts from the Greek situation. But just on Friday, we've seen here finally a small red candle, a sense of warning, because the tension between the Greeks and the rest of the European Union has really increased. So I think in many ways that could be a big driving story. It's really the political story that's going to be driving it. On the technical side, the critical test here is, of course, these 111 lows. That's really where we're going to be watching as a key potential for a double bottom. And if we can hold these lows and set in a double bottom, that would really give people a lot greater confidence that the euro may have finally found a more stable bottom with a potential move all the way out to 115, which is where the resist now lies, on a counter trend rally. So lots of interesting resolutions here. On the other hand, if if we get a situation where maybe they come to some kind of terms and negotiate a modest compromise, the potential for the euro short covering rally here, irrespective of what happens on the U.S. side, I think is quite strong, and we could have a move all the way up to 115 earlier in the week. So this typical very low volatility moves that we've had, this compression of volatility after massive volatility moves, generally suggests a breakout one way or the other. So far, the breakouts have all been breakdowns, but don't be surprised for a short covering squeeze. And in that sense, I think the other interesting thing to look at, something that we've been talking about all of basically the last half of last week, is the bounces in the euro. If there's a bounce in the euro, on the crosses, look most pronounced in the euro-pound pair. And that's because the situation on the UK side suggests that there's very little possibility that the BOE is going to hike rates for a long time. So if you get a short covering squeeze rally here, the euro-pound trade could move ourselves all the way out to 76. But if you look at the signature of what's happening in the euro-pound versus what's happening in the euro, it's a very similar kind of a thing. Huge downside, modest retrace, and then now at a point where we're either going to make a double bottom test or continue to squeeze higher. And the way we're trading, if we take out the highs here, it's certainly going to give us a much greater confidence that we can take to 76s. So therefore, I think the other big pair to watch on the euro side, aside from the euro Swiss, is the euro pound, just on the strength of how short covering the euro will be. Dollar yen, on the other hand, has just been a complete compression of volatility for really almost the last month. And what's troubling about the dollar yen is it tells you a story about the dollar that I think is not something most people want to hear, which is namely that the rally has died. We've been talking about the fact the rally has died for about a month, but if you look at the technical signature, the rally looks to be dead already for 2 months in many ways. We've made highs, we've made lower highs, we've made lower highs yet. What will seal the fate of a downward move in the yen? a break below this 115. I mean, it seems like we continue to compress lower and break down. Of course, the big thing is going to be the non-farm payrolls this week. But what the market is kind of, I think, saying here is that the assumption of moving towards normalization, the idea that the Fed is going to hike rates in June, looks more and more remote. The 10-year bond continues to go the other way. We're now trading like, I think, 172s or 170, 174s, well below even the 2% level that we were at just a couple of months ago. And all of that suggests that there's a potential breakdown to the downside. Now, if you add to that the possibility of stock market sell-off, you have a very strong chance here of a move down to the 115 level. And I think that is something very few people are anticipating. So therefore, the more unexpected scenario here is a move to the downside rather than a move to the upside. And definitely bears watching. The fact that we have not been able to take out the 1850s for so long is a very negative development. On the other hand, if we have a massive rally, if we can take 1900 and hold on a closing basis 1900, that would definitely change the tone of this whole chart and the whole structure here to a much more bullish construct. So watching this quite carefully, watching the breakdown below the 17s could give you some very strong clues. There's no doubt, I think, that the buyers are going to come in on the first try underneath the around the lows, around the 1550 lows. But the problem is that even if you have a small bounce, if they break those in the next couple of sessions, the move down below 1500 could really wash out some very long-term longs. And therefore, I think dollar yen is very vulnerable to the downside because of that. The pound is just kind of flirting to me with this very key 150 level. We've made a few runs underneath it. So far, they've been bargain buyers underneath it, and everybody's been squeezing it up. But every rally off of the 150 has been relatively tepid. We've really not had any kind of a V-shaped bounce. The longer we stay here, the more the possibility that we can build a longer platform for a potential turn back to the upside. But on the fundamental side, if you look at cable, there's just very little going on here that gives you confidence that UK economy is picking up steam again. It's in fact the other way around. It's slowing down. And a slowdown suggests that the BOE stays on the sidelines, doesn't do anything on the monetary policy for quite a long time. So unless the tenor of the economic data changes, there's a potential here that 2, 3, 4 batterings of the 150 could eventually break this all the way down, and the next level after that is going to be 147, which brings me, to the reason why I think cable is very vulnerable to further downside. Now, Aussie is going to be the other huge story of the week. Aussie has been a complete disaster for the longs and an unbelievably strong trade for the shorts for a couple of reasons. One, commodities have just collapsed completely. Two, Bank of Canada surprised everybody with a rate cut, and that's now created a huge expectation that the RBA is going to cut rates this Tuesday. So in many ways, this whole 77 level now has become the Maginot line, where if the RBA does come in and suggest that they're going to cut rates, or it doesn't even have to cut rates, if they come in and say, we're going to cut rates next time, and it's going to be the start of a new easing cycle because we think it's necessary for the Australian economy, if they come out with any kind of a statement, excuse me, that says rates will go down the other way for more than one sustained move, that's all going to be very negative and really has the potential to push Aussie all the way down to 75. If they don't do anything, if they literally come out with the same statement that they came out with last month, the potential for a squeeze here is quite high because the whole expectation here has been on interest rate compression. If interest rate compression doesn't happen, the Aussie still remains one of the more decent carry trades in the currency market, and a squeeze to the upside could definitely take out a tremendous amount of late shorts here and take us all the way up to 180, which is a natural resist level, before you could even blink an eye. It's in one of those kind of things, right, where I think you could have a 200-point move to the upside in a day on a surprise non-rate announcement. So lots of volatility potential here as we go forward. Dollar CAD is the other interesting trade now. The dollar CAD has really continued to the upside, just like all the excuse me, commodity pairs have declined, and the move here may have been in some ways almost parabolic, right? Because we've had negative Canadian data followed by rate cuts, followed by further falling oil prices. But oil had a huge rally on Friday, which created a spike top in the dollar CAD level. So this 128 now may be the level against which you want to trade on a short-term basis for a potential move now to 125, which used to be resistance, but now becomes, of course, support. So those who are brave enough to want to try to pick tops here, this trade, to the downside, may be an interesting trade at the beginning of the week, just simply because this parabolic move could finally have run out of gas, to use a bad pun, on the fact that oil prices are finally starting to stabilize. And then lastly, taking a look at the Kiwi, which has been actually a sideshow, not nearly as weak as the Aussie, not as weak as the Caddy, but still just getting dragged down by everybody on the commodity basis. Here, the 72 level seems to be the support level here. There's not much news on the excuse me, New Zealand side, although the RBNZ did try to beat it up by saying that the currency remains way too high. But the bottom line is that they're not definitely going to cut rates at all. Rates are going to stay the same. Kiwi is going to be the highest yield trade in the currency market, and that makes the Kiwi, from a carry trade basis, still a very, very attractive trade. Not much to trade it against. If you're negative yen, it's kind of hard trade against the yen. If you're negative Swissy, it's hard trade against the Swissy, and it's very, very hard trade anything on the Swissy side. But still, there is a potential here maybe for some Kiwi trade to the upside, perhaps even Kiwi CAD, or if you get, this is the interesting trade, if you get the RBNZ, the RBA cutting rates, then this is a trade in many ways that could take us all the way down to 105 and back down to 104. In some ways, the short Aussie trade, aside from the Aussie, could be really well expressed through the Aussie Kiwi on any kind of RBA dovish statement. So that's how the week shapes up. I wish you the best of luck, the best of trading. This is Boris Schlossberg, over and out.